There is only one reason why so much debt has been created. The question is, how will we ever manage it? You came here for the truth, so let me unveil that for you. Debt is the system of control. I talked about debt in the previous video to this one, which very few people watched, and I talk about how you can look at debt as in credit card debt. Or maybe you want to understand that debt could be the national debt. But there's so much more than that. We have derivatives that are interconnecting all of this. Now that's really key to understand. But then we look at margin debt, which we'll get into today. We're going to look at other factors, which I think are really key to understand. So we're going to bring that full circle and talk about the economy and how it is all riding on the Federal Reserve continuing low interest rates, tons of money printing for the foreseeable future. But is it possible that they are unable to keep this up forever? Well, we'll talk about that. This is an article out of Market Watch. More investors than ever are borrowing to buy stocks. Here's what this really means for the market. And let me just quickly show you the chart that corresponds to that. Rising and falling in lockstep. S&P 500 and the NYSE margin debt since 1970. Should it surprise you that this has been consistently going higher and higher and higher? Of course, this is what we see. We see extreme risk taking today. You can look at all different indicators. They have somewhere around the territory or have exceeded what we saw back in 2000, long past what we saw during the financial crisis and every bull before this. Now, does that necessarily mean that it's going to crash tomorrow because of this? No, but it shows you the extreme risk taking. And as a result, as you can see in these cases here, why it's not a perfectly straight line up, there are times in which the margin calls come in and investors are left without a shirt. Okay, so we're going to look more into this article really quickly. I just really want to point something out. Margin debts, all new all-time high, is neither bullish nor bearish, according to this Market Watch article. I'm referring to the total amount that investors have borrowed to purchase stocks, because the effective margin is to leverage stocks gains. Its market-wide level is a measure of investor confidence. To the bulls, they would say that this is good because this can accelerate the market further. If there wasn't margin, the stocks wouldn't have gone this high. And then on the other end, the contrarian indicator, high levels indicating dangerous levels of speculative excess. And absolutely, that is the case. But it doesn't tell you here why exactly this would necessitate a deleveraging. That doesn't happen. In fact, the market continues to expand and exaggerate everything until it doesn't, until there is a spark, until there is a trigger, until there is an event which turns it on its head. So we need to pay attention to that. But the point is that there is this speculation and there is this excess that is always met with disastrous consequences at some point. So the message, I believe, should be very careful what you're doing with the debt. And we're going to talk more about that in the Money GPS Insiders later in this video. The next thing I want to talk about is the Citi Economic Surprise Index, something that has now, believe it or not, hit into the negative. And it's been a little while. In fact, haven't gone into this territory since, I would say, June of 2020. And as they mentioned in the article out of Bloomberg, in and of itself, it's not that big of a deal. The surprise index simply measures the degree to which the economic data is either beating or missing economists' forecasts, with a negative reading occurring when recent reports have missed in aggregate. So I'm going to look at it through the lens of it's not accelerating fast. The growth isn't coming as fast. What does the economy need? It needs more stimulus. It needs more stimulus. It needs a shot of adrenaline. Why? Because $120 billion going into the markets every month isn't enough. Because giving out a stimulus check here or there That's not enough. They need to accelerate it in order to get the growth even higher. That must come at the with a consequence, and that is the devaluation of the currency. There's no other way to put it. Now, I found this information to be very useful. I wanted to bring it to you. You're looking at Bank of America's information, comparing what we're seeing today and sort of highlighting the similarities between, this period, and they're showing us between 1968 and 1976. The changes there could be similar to what we're seeing now and into the near future. And, without getting into it too much, I simply want to note, as you can see throughout this, by the way, the darker blue line, that's the Dow Jones, and then the lighter blue line, that's the Fed funds rate, but that's inverted, okay? And essentially, they are moving together, showing you that when there is a problem, when they have inflation, they respond to it by increasing interest rates. Of course, like I said, this is something that throughout this period, inverted, remember, they're increasing. The Fed has to, initially, they actually bring down the interest rates, get things going, and then we start heading into 1980, where they went crazy on that. It all depends on where you're looking at this. I'm just trying to highlight the fact that there are some similarities. They highlight some very important points. Number one, the end of Bretton Woods, in 1971, what happened there. And of course, as a result, you've got this massive, massive level of inflation. I don't think a lot of people, the average person, understands the importance of Nixon pulling the whole world off the gold standard and how that affected debt afterwards. This is very key, but yet it's just not understood even by most economists. Value bull of 1968, followed by the volatile bear 1969, and they're just giving you 1967, 1968, 1969, going through which of the sectors were doing well during this period, I should say, or doing poorly. And you look at 1967, small caps, tech stocks, growth, and then you go down value and so on. But right at the top of the list, you got small cap and tech stocks. Now that does have some certain similarities to today. 1968, certainly you could see right here, banks and value, small caps are starting to decrease significantly, but you see banks and value in the top two spots. Then we go to 1969, volatility at 99%. Copper is in the second spot. So that just shows you how things can change in almost an instant. Looking at this, I want to tie this together here. The Federal Reserve Bank of Dallas President Robert Kaplan, who I've shown you quotes from before, repeated his call for policymakers to begin a discussion of slowing their asset purchases. And this is something that I'll highlight right here. I'm going to bring in the highlighter. Maybe taking the foot gently off the accelerator would be a wise thing to do here so that we can manage the transition more effectively. That's why I have encouraged sooner rather than later we begin a discussion of these purchases. He's saying something the rest, quite frankly, will not. All of this, everything I'm talking about today, and of course in previous videos, is riding on extremely low interest rates to stay there. And remember what they said, 2023, all the way through 2023, 0% interest rates. 2024, we'll think about it. And the highest that they claim, according to the dot plot, is 2.5%. That's where they're going to go, but that's going to be 2024 and beyond. Okay? And the purchases will have to continue for the foreseeable future. But what if that changes? Certainly their whole plans are being completely destroyed. None of of these stocks, none of the markets have priced that in at all. Remember that as an investor, that is extremely key. First and foremost, number one, debt is the system of control. People need to realize why this system was created in the first place. It's so that those who are managing this system have complete and utter control. When we look to certain individuals and we say, that guy's a bad guy, he's a billionaire, that guy did this guy did that, we don't understand the structure. The structure itself is created so that they can have maximum control. And who is in charge of this system on the surface level anyway? It's the central banks. We must actually know what number two is all about, and that is debt allows you to use leverage, which can increase your wealth. If you had to buy everything exclusively in cash, you wouldn't be able to purchase a home, for instance. Today, not many places you can buy that home. So utilizing leverage in a manner that is, let's say, cautious, maybe, but optimistic, you can do so and actually, get something you normally wouldn't be able to get. But if you're going to go to the store and on your credit card buy something and you're not going to be able to pay it back month to month and so on, that is going to be devastating for you. And then we have number three. Unlike the national debt that will never be paid back, you have to do what you can to pay off all forms of bad debt. All forms of bad debt must be paid off as soon as possible because that is definitely constricting your ability to increase your wealth long term. The market is wondering when the next stimulus is going to come around, and so are the people. Here you can see, will you get a fourth relief payment? Of course, it is coming. We know that as a fact. It's obvious. You've got an issue here though, okay? What's been happening is that there has been such an accumulation of debt that handing out people $300 a week or a $1,400 stimulus check isn't going to do it. Just look at the delinquent student loans, $435 billion. And they say right here, US taxpayer funded. You've got maybe the potential that they're going to cancel some of that. So why are people going to pay it back? That's the way that they look at it. 64% of millennials have regrets about buying their current home. Here's why. They mention many different reasons. Maybe that they spent too much more than they thought. The amount of debt that they took on is too much. They didn't realize how much time it takes to actually take care of a home and so on. But a lot of people right now, younger people, have taken on a lot of debt, and it's good debt, as they say, but if they cannot service those payments into the future because of some problem that they're having, this is going to be an issue not just for them, but for you too, because of the derivatives. Always, always remember that. And then we've got this. I'll finish it off here. I always view this job as temporary, and I really do want to find something that fits my career and background better. Some workers are saying that having this time not working and getting the unemployment benefits help them prioritize their mental and physical health, help them prioritize their careers and so on. So people are laying back right now. Some people laying back and they're deciding that, maybe I want to change. Maybe I don't want to do that job at McDonald's anymore. Maybe I'm going to do this instead. So I think there's going to be this big reshuffling that's occurring. Ultimately, a lot of people, they don't want to go work at that restaurant anymore or drive the Uber and so on. That's why you're getting these sign-on bonuses from McDonald's, $500 and so on. I think this is really huge. I think it's important to watch because the economy could change rapidly and there might not be that growth that they need. That's why they're pumping out the stimulus to try and fill in gap. Look, I need to ask you something. If you want to communicate with me directly, I've got one very good way, and I brought this after procrastinating for such a long time. You sign up to the Insiders. It's my video, 5 days a week, emailed directly to you. I am going around their systems. I'm taking every single precaution. I'm going and pulling out all the stops. I've got big plans coming. This is going to be a big change at the Money GPS. We are looking into everything, all the details. I'm going to be doing everything that I can, and this is one step. This is one major step. You can sign up for free, of course, at themoneygps.com. If you found the video informative, give it a thumbs up. If you hated it, give it a thumbs down. Thank you for that. If you want to learn about my 2 books, so much detail in here about the central banks and so on, interest rates as well, all topics about how to make money, all of that in here, these 2 books. Check them out at the link or go to themoneygps.com. If you haven't seen this video yet about debt, I would highly recommend checking it out. Click it and I'll see you there.